Hello, everyone, and welcome to another episode of the Business Growth Show, where we talk about all components of business and how to utilize them for exponential growth. My name is Athin Cassiotis. I'm a business growth expert where I help business owners grow and scale to create wealth and freedom. And today, I have an awesome guest. He's the president of Segment Wealth Management, Fiduciary Financial Advisor, and best-selling author of Foolish. He is a disruptive wealth management pioneer, and after battling UBS in defense of 100% ETF portfolios, a director sole on the firm's fee-rich mutual fund business, he was on the original beta test team of 6 advisors permitted to run discretionary ETF portfolios in 2002. And he has since been named one of the top 20 ETF thought leaders in the US by Barron's and the Wall Street Journal. And his fee-only fiduciary firm, Segment Wealth Management, is a top 15 firm in Houston as ranked by the Houston Business Journal. He's perennially named as a top 50 advisor in Texas by Barron's out of the state's 26,002 registrants. And he's also the best-selling author of Foolish, How Investors Get Worked Up and Worked Over by the System. And his book takes readers through the dark tunnels of the brokerage fee ecosystem and takes them on a deep dive on investors' self-harm tendencies driven by ego satisfaction. And Segment Wealth Management is a leading financial advisory firm founded on the belief that low fees, tax efficiency, and maintaining a long-term perspective are key to financial success. And Segment specializes in investment strategies and provides asset management services. Welcome, Gil Baumgarten, and thank you for being on my show.
Glad to be here. Thanks for having me.
Yeah, you're welcome, mate. It's going to be an awesome show here, I'm sure, for everyone watching and listening today. So, you're a very successful entrepreneur. So for those people who don't know who you are, please introduce yourself by telling us about you and your journey.
Sure. Well, I've been in the investment business for 39 years. I used to work for Smith Barney, which is now Morgan Stanley, and I worked for UBS. I spent 15 years at Morgan Stanley and almost 11 years at UBS. And then 13 years ago, started an advice business where I could advocate for outcomes for clients as opposed to a more process-oriented perspective that the brokerage industry tends to have. And that's what I wrote about in my book, Foolish, about some of the dark corners in the brokerage industry and how they operate and how clients may be harmed by that and what other choices investors have with regard to how they establish their relationships.
Yeah, awesome. I love that. Such a powerful background of where, all the experience you've got and then where you've gone and where you are today. So love that, mate. Let's get into it. So I think a big one, that I'm seeing and for myself as well as other people in investing and growing our wealth is actually the mindset behind it, right? We need to be able to change that mindset to an extent to allow us to be successful. So can you tell us a little bit about what mindset traits we need to be successful at, investing and growing our wealth?
Well, it's human nature to be fearful of losing money. Several investment psychologists have written about it, and Daniel Kahneman is probably the most prolific writer about investment strategy and the psychology of it. And he determined that investors experience the pleasure of a gain at 1/3 the rate that they experience the displeasure of a loss. And so if somebody were to make $100, they would feel that as a jubilation measurement of a 3, whereas if they were to lose $100, it would be a 9 or a 10. And so people's mindset is built specifically to avoid losing money rather than actually making money. So we are wired to not want to lose. And that's an unhealthy mindset because there's $100 up for grabs either way, but we tend to spend a disproportionate amount of time trying to eliminate our losses rather than pursuing gains, and that tends to harm long-term results. The second thing I would say is that people have a tendency to be naturally transactional about the way they approach investments. They want to visit for a little while on this and then flip it for something here. And so they always want to feel like they are in the game. And the way taxes are calculated here in the US, that's very harmful to returns because an asset that gets flipped inside of a 12-month time period is taxable at up to 42% of your profits. And if you have a loss, it's not deductible except $3,000 against ordinary income. And so the government here in the US wants a very large portion of your profits, but they don't want any portion of your losses. And so the system is not designed to compound wealth by a transactional methodology, which most people have fun doing but it's not particularly encouraging with regard to the results that they actually produce.
Yeah, so interesting, and I love those mindset elements about how we need to change those as well. And what are some of the common mistakes that you see, right, when the people are investing and managing their wealth?
Well, when I tell people how harmful taxes are to their returns, they are stupefied by how terrible the math is. If you own a stock and let's say you've got a 25% rate of return, in the US, when you think about the ways you pay your taxes here, the next stock that you buy has to outperform the stock that you sold by 69% just to beat the friction of the taxes that you have to pay from coming out of the position that you currently own. And most people don't look at it that way. Since trading commissions on these trading platforms, Schwab or Fidelity, are very popular here in the US, since trading commissions have gone to zero, people naturally assume that the friction of the process is also zero. I can just willy-nilly swap from Coca-Cola shares to American Express shares or Apple computer shares. It doesn't really matter. I'm after whatever profit I can get. Well, people just don't understand that the stock that you buy has to outperform the stock that you sold by 69% just for you to remain even, when you consider all the ways that taxes impact the way you've sold your shares. So that's the biggest mistake, is people not understanding taxes and the impact on long-term results.
Yeah, I love that. So powerful. I love the tax conversation, because any way that we can legally keep the most money as possible is definitely for us, right? In there, so it makes a lot of sense, and love that area. And let's delve a little bit deeper into like some of the most important factors to consider when we're developing like an investment strategy. Like, what investment options generally are there for people that may be new to investing in wealth?
Well, when people have money to invest, the first thing that they're going to come to, the first fork in the road, is whether they are a saver or whether they are an investor. A saver typically wants liquidity, so they want their money to be able to come back to them fully intact, and they want some type of an incremental rate of return while they have parked their money for a little while. Fortunately, rates of return in money markets and CDs and short-term treasury bonds here in the US have gone up a bunch. And so there's much more compensation involved in loaning your money out for short periods of time. But if you're willing to expose yourself to the uncertainty of the future, much better rates of return are available. That would be real estate, which is illiquid, or private equity, illiquid, or the stock market, which is liquid but not predictable. And so the first fork in the road is really, do I want a finite but low rate of return, or do I want a higher but unpredictable return? And then that's going to sort of determine the path that they go down. The treacherous part of that is when somebody really convinces themselves that they are an investor, being willing to accept an unknown outcome, and then they find out as soon as they've lost a little money that they're really a saver. And then they'll liquidate and take their losses and then repeat the process over and over again, only participating until they experience a loss, and then they liquidate at a loss, which pretty much guarantees you'll never make any money. And so that's the pattern of behavior that we see repeat itself when people aren't coached into better ways of thinking about how to approach their investments.
Yeah, I love that. And I love the coaching element as well, right? Because you got to be able to think differently and think ahead a lot of, what the benefit's going to be. And let's talk a little bit now about some of the key indicators that we should look for investors when we're evaluating potential investment opportunities. So what are some of these factors that we should be looking for when looking at what to invest in?
Well, I'm of the belief that you should systematically invest over time, because it minimizes the importance of the decision at each one of those moments in time. I don't think it's wise to sort of venture into the interpretation business whereby, well, now we wet our finger and we put it in the air and we see which way the wind is blowing, and then we determine what it is that we're going to do. If you were going to do that, the most reliable thing would be to be a skittish investor when you see interest rates rising, or you see a looming recession on the horizon like we have today. So I would say that I'm a little bit more skittish today than I have been in the past. But although I still maintain equity exposure for our clients, we have $1.3 billion of their money, and I have my own money invested in the same types of vehicles. So I do have a little bit larger cash balance now, both for myself and for our clients, just simply waiting for the recession that everyone has been talking about for the past year, but has seemed somewhat out of reach. But it seems to me like it's beginning to approach.
Yeah, love that. Really, really powerful. And yeah, it's interesting with the recession things and everything like that, economic uncertainty with people and how that changes markets. Let's talk a little bit about that, but also diversification, right? Because it's sort of linked in a way where, having, a variety of things there. So can you talk a little bit about that and the importance of, diversification in our wealth management as well?
Yeah. So if we were going to have a recession, then stocks are one of the worst performers in a recession. So a recession is just a contraction in the profitability of being in business, and it makes it quite a bit more dangerous, especially if you've borrowed a lot of money and you're having to service that debt. So stocks tend to do very poorly during periods of recession, but at the depths of those recessions, when all seems lost and it's seemingly hopeless for the future, that's where the prices are the most compelling in the go forward period. Warren Buffett says that minimum stock prices arrive with maximum uncertainty, and maximum share prices arrive with minimum uncertainty. So when everybody thinks that they have the future all figured out, that's just the moment in which the time in which the rug is going to get pulled out from underneath you. Whereas if you invest heavily during the throes of a recession, you're paying normally very little for the companies that you buy. And when the future turns, surprisingly to everyone else, your money has already been invested at a very opportune price, and the future will provide a much higher rate of return in the recovery. And so I think a lot of people view stocks as something that they're so fearful of that they only want to visit a little bit at a time. And I'm really more of a permanent investor in it. And I add and subtract from my core position based on whether I think prices are high or prices are low.
Yeah, awesome. Love that. It's really powerful. And I definitely heard that, a lot of wealthy people like doubled, if not more, their, wealth, right, during COVID because of
That's right.
that uncertainty, because they were looking at the opportunities, right, that were out there compared to everyone else.
Yes. And so if you went back to March 23rd of 2020, the stock market was down like 11% on the 23rd, having sort of crescendoed in a 35% sell-off that had occurred in about a 90-day time period. And the world seemed like a very scary place because it appeared as though everything was going to shut down. But before COVID really ever got going, and all you had was uncertainty at the time, and our beliefs sort of manifested in the subsequent time period, the 23rd was actually the bottom of the market, and that was just the beginning of COVID. So anybody who positioned themselves heavily in cash to wait it out until they have some certainty missed the best part of the recovery. And the more violent the downdrafts tend to be, the more violent the updrafts tend to be. So on the 24th and 25th of March in 2020, the recovery was 17% in a 48-hour time period. So 50% of the loss that had occurred in the prior 60 days, sort of leading up to the COVID sell-off crescendo, 50% of that was recovered within 2 trading days. And if you were sitting around waiting for it to get a little better, you missed the best part of the recovery. So it can be really treacherous.
Yeah, I love that. And this is why you need people, that know these things, that are on the point of knowing when to buy and sell and everything like that, because it's really powerful. And, you were talking a little bit about the different types of investments, right? With stocks, with, real estate, for example, with private equity, like, investing into companies, let's say, and, beforehand. Let's talk a bit about risk tolerance here, because, everyone's got different risks elements. So how can you tell us a little bit about that, how people can determine, how they make their decisions, depending on their risk tolerance?
Yeah. So I think that because stocks have an unknown future, and the timing of when you enter and exit can be so vexing to try to figure out, I think we should look to somebody like Warren Buffett as a good example. He stays permanently invested in equities and only trims around the edges. Now, your listeners may not have a tolerance for their entire net worth to be slung around in such a way like the 15-month time period of January of 08 through March of 2009, if you'd been invested in the S&P 500 or a broadly diversified basket of U.S. equities, you would have lost 58% of your money in 15 months. And so if you look at that as sort of the worst case scenario, because that's one of the worst markets that we've experienced in our country's history, how much of that would you want? So if 50% is the number that you can handle losing 58% of your money on, then you should probably be doing something else with the other 50%. And I would also warn people to not be fair weather or foul weather investors. It's sort of like a permanent capital exposure. I want a certain percentage of my money to be invested with equities as the upside, because you're not going to be able to predict when the good time or bad time was, and you're not going to be able to predict it surely in the go forward period. You only can look out the rearview mirror to see what you should have already done. And people tend to make decisions today based on what they should have done a month ago or 6 months ago, which virtually assures that your timing is going to be terrible. You're way better off to pick some type of an allocation that you can live with consistently and just let it roll. So if that's 50%, or in my case, I probably have maybe 60% of my assets in stocks, but I also own oil wells and commercial real estate. I have several homes, and I have equity in those homes. So there are other things that I own. So, and not everything is connected, which is the whole point of diversification, is to make sure that everything is not moving in lockstep based on the same information. So if you had thrown all your money into equities just before the 08 sell-off, you would have lost almost 2/3 of your money. So it's comforting to have something that is going to go the other direction or not move at all. And that could be real estate, or it could be cash. It could be CDs or treasury bonds. Here in the US, I'm sure you have something similar in Australia. So that's the way I would tend to approach it. And not adding and subtracting from my allocations all the time. People tend to mess with their investments too much. They should pick more permanent types of exposure and let it percolate.
Yeah, I love that. So true. I love all those different elements there. Let's talk about tax now, right? Because we touched on it a little bit earlier, but I think this is a big topic and very beneficial. And obviously this depends a little bit on the country that you're in, because every tax is different, but we'll talk about the US tax elements, because that's obviously where you're from. So initially you mentioned before about, with an asset now, you get taxed a huge amount if you sell it within 1 year. So obviously you'll want to stay longer than a year, but let's talk generally about tax strategies. Like, what are some other tax strategies or things that people should be looking at to reduce their tax liability?
If you do a couple of things correctly, you can pretty much double the history of all your returns. And so if you're returning 8%, most people would give their right arm to have a history of producing a 16% rate of return. Well, you can actually produce an effective 16% rate of return simply by aggressively managing the taxes on your 8% rate of return. How would you do that? Well, first thing is you would never sell a piece of property that for a profit that you had owned for less than 12 months, because it doubles the tax rate. And in the US, high taxpayers, so say someone filing jointly making more than $600,000 per year, they're going to be in the 37% tax bracket. There's a 3.8% Medicare surtax that also applies to investment income. So let's call it a 41% tax to earn wages, to earn rents, to earn interest on a taxable bond, or to have a short-term capital gain. If you had waited to the 366th day, the tax rate is capped at 23.8%, not 41%. So you would make it a policy that anything that you ever sold, you would want to have held it for longer than 12 months, because it cuts your tax rate in half. That's policy number one. Policy number two is that you really wouldn't want to even be taking capital gains at all. You would want to buy positions that you could hold for the rest of your life and not trade in and out of them. Well, why do I say that? In the US, the aggregate value of all your accumulated profits are forgiven at the death of either spouse. So if I buy $1 million piece of real estate and it's worth $5 million, and I buy it when I'm, say, 50 years old and I live to be 85, my $1 million becomes $5 million. That $4 million increase would have been taxable at up to 41% if I sold it inside of a year. It would have been taxable at up to 23.8% if I'd sold it outside of a year, and it's not taxable at all if I never sell it. So when the surviving spouse inherits it, it's tax-free to them. And when they die, say the wife lives another 10 years, because the men always die first. The wife lives for another 10 years, it's tax-free a second time to the children when they inherit it from the mom. So you would change your thought process about how long you're going to hold something. I think the proper time period to hold it is forever. And so it would lead you to buy vehicles more like ETFs and mutual funds that didn't distribute capital gains, rather than individual securities that you might get rattled out of by thinking that the healthcare business is going to collapse, or whatever it is that would jostle you out of your position. So it would strategically change the way you would address the construction of your portfolio. The third thing that you would do is that if wealthy people tend to give a lot of money away, and so you would not use cash as the vehicle that you gave away. It would be your permanent vehicles that you had bought, that you had already tripled your money on. You would give those to a charity because those are tax exempt when they sell that security. And you would take the cash you would have given to your church or synagogue or whatever it is that you believe in, and you would have replaced that security and bought it at today's higher price. And you'd be rinsing the capital gains out of your holdings. So if you rinse capital gains by charitably giving, if you hold your positions longer than 12 months and hopefully for a lifetime, those two things right there would practically double all the returns you would ever have from actively managing your portfolio and reshuffling your cards all the time. So that's why I said early on, it takes a 69% higher rate of return from each subsequent purchase to escape the friction that you have created by your first sell. And so it would just change the mindset of what it is that you're really trying to accomplish. Am I building my portfolio to feel good about it, or am I building my portfolio to make money from it? And if you're trying to make money from it, you're going to approach it a very different way.
Yeah, I love that. So powerful, all that whole section there. And I love to delve a little bit deeper into the tax stuff, but especially around structuring, because I think this is really important where, if we have something, for example, in our own name, there's a lot of risk there if something happens, right, to us, if we get sued. And I know in the US, especially, there's a lot of suing happening over there. Whereas, if we have the asset in a LLC company or a trust or a different type of corp, there's a lot of different structures. So do you want to just talk a little bit about some of these different structures and, to protect ourselves, and while also being able to save tax, right, at the same time?
Sure. Yes, I own several pieces of real estate that I have in separate LLCs because I run the risk of a trip and fall on my property. I do have insurance for that, but if I were to get into some type of legal entanglement, I wouldn't want that legal liability to spill over into my other assets. So I compartmentalize that inside of an LLC, but from a tax standpoint, it all flows back through to me. And there is some attachment of legal liability that you're going to have a difficult time breaking if the entity does flow 100% back to you. And that's the reason why I carry liability insurance to sort of back up my LLCs. In the US, if you have a trust, trusts reach that. Remember previously when I said $600,000 worth of joint filing income gets you into the top tax bracket of 37% in the US, be 41% with the Medicare surtax. A trust in the US hits that 41% tax bracket at only $13,000 worth of income. And so trusts have a punitive type of tax structure because in many cases, they're getting some estate planning benefits by giving money to another generation in the form of a trust, and that trust has the problem of paying a much higher tax burden. That can be navigated because they also get the benefit of the reduced taxation on dividends. So dividend income from a company would be capped at 23.8% tax rate, and a long-term capital gain would also be capped, although the trust would not get the step up in basis rule where a death would erase all the capital gains tax. But that would lead you to believe that if I had a trust, I would definitely not want to have rental real estate in it. I would definitely not want to have interest-bearing bonds like treasury bonds or corporate bonds that I would be choosing to pay a 41% tax on that when I could have achieved dividend income or long-term capital gains at half the tax rate. So that's the way you would structure these types of entities and how you would navigate the higher tax brackets that might be coming with them.
Yeah, awesome. Love that. So amazing here to know all this stuff, because extremely important, right? A lot of people, and obviously not only speaking to yourself about the strategies, but getting a good accountant as well, right? That can help you to structure these things is important to work together. And I think that's an interesting one as well, where some people with their investing, there's a few different players, right, that need to happen in the investment, like you're, like a wealth advisor, I guess, or however you help people to grow that. But then you need your accountant as an example, right, to be able to do the structuring. Potentially, you might even need a lawyer to do some of the agreements and things like that.
Sure.
So, and there might be some other factors, but sometimes they don't always talk to each other. And the accountant strategy must talk to the wealth strategy, because they can potentially be on different paths. So, do you want to talk about maybe some of these relationships and things to watch out for to make sure you're on the same page?
Here in the US, the majority of CPAs that do tax returns really only do tax returns. They don't consult with, many do not consult with their clients about how to optimize their tax strategy. They would not, in many cases, circle back and say, well, did you know that if you formed an LLC, or did you know that if you did this or that, this would have turned out better for you? They pretty much just aggregate the information, they fill out the forms, they send the tax return to the client for signature, and that's the end of it. And so you have a big gap in the center of the typical advisory relationship, where the wealth advisor oftentimes does not get involved in tax strategy. The stockbroker that they're doing business with does not get involved in it. The lawyer is not consulting, and you end up with this big black hole in the center of the client's life, where the strategy about what to do falls upon them, and they really don't have an advisor to help them with that. That's sort of the place in the marketplace where we try to find ourselves, is telling people structurally about how a Roth IRA conversion works, and the good part and the bad part. And that's another interesting part of my business, is that we don't sell anything. I'm not allowed to earn a commission of any type. I'm really in the advocacy business. I tell people how things work and what the good part is and what the bad part is, what the trade-offs are, and you make your own choice, and I'll help guide you through that. But I'm not here to convince anybody that they should do it this way or that way. I have my opinions about better ways and worse ways, and my job is just simply to expose our clients to what those thought processes are, and they can make their own decision about what they want to do.
Yeah, I love that. These are high level conversations, right? And then being able to ask the right questions, to you. I know for me, I go to my accountant saying, and I used to live with a lawyer, which helped. So I used to understand a lot of this stuff. And then I'd be like, I want to do this, this, and this. Can I do that? Instead of just taking it, what they say, it's like, actively want to learn this, right? So what, Gil's sharing with us today is really powerful, right? So take some of this stuff and, whether you, speak to Gil about it, but understand this and ask the right questions, because that's really, questions are the answer, in what we do here, and up level yourself at the same time. And so people, let's say they're getting older now, right? We've talked a little bit about, passing on things, but they want to get to a retirement age, right? Where maybe they're not working as much, and they want to get some financial security. So how can you, what are your thoughts around like a retirement plan, I guess, so they can get that security and live comfortably in whatever their means are?
Well, I think that people ought to think about that long prior to their retirement. I'm 63. I will probably work until I'm 75. I like working. But for the past 5 or 6 years, I've already been buying vehicles and investing in rent properties and the like that'll give me mailbox money. And so one of the things that I've done is that in the US, mineral interests on property, the property owner doesn't own just the surface. Here in the state of Texas, you own the rights to drill for oil wells underneath it. And my son is in the business of buying those oil wells and the rights to drill more of those. And that's a very prolific producer of income here in Texas. And so buying mineral interests and investing in mineral partnerships, buying oil wells, those types of vehicles. It could also be a rent house or something that would generate consistent income. Could also be a dividend paying stock portfolio, which is taxed better you're capped again at that 23.8% tax on dividend income. So, and you get 100% of the upside in the stock, which is not taxable until you sell it. So I would think that rental properties and minerals and dividend paying stocks and even bonds, here in the States, we have what's called a municipal bond, where a local government, it could be a school or a flood district or a river control or a dam project or something along those, can borrow money from the public, and the interest that they pay is tax-free to the recipient. And that, of course, lowers the borrowing cost for these local entities to raise money to build public infrastructure. And so municipal bonds are a very common part of a retirement portfolio here in the US for people who want a predictable outcome and non-taxable interest being distributed to them on a biannual or a semi-annual basis. So those would be components of building mailbox money, if you will. That's the local term for, creating a cash flow centric type of investment policy. I would not wait until I'm 6 months from retirement to begin to think this way. I would start doing it when I'm in my 50s, as I'm looking forward to my retirement, because a lot of these things really take a long time to percolate, and you wouldn't want to suddenly have to convert your assets into this way of thinking or this new way of thinking. You could have known about that long before you arrived at that destination.
Yeah, I love that. So true, right? We want to be able to, get that money coming in and enjoy life after that, with whatever we want to do on the side. And let's talk about your best-selling book called Foolish, how investors get worked up and worked over by the system. So tell us about it and how it can help us.
Yep. So the first third of the book is how the brokerage industry operates. I was in the brokerage industry for 25 years. I tried to navigate it as best I could to create a advocacy type of mindset with regard to how I constructed client portfolios. But the brokerage firms put a lot of pressure on their advisors to do particular things that are profitable for the company that aren't necessarily profitable for the client. And because they're not in a fiduciary relationship, it is a sales-oriented process. You're not entitled to know what the used car dealer has paid for the car that you're trying to buy from them. And in the brokerage industry, it's much the same. You're not entitled to know what they are making, and they're not there to look out for you, just like the used car salesman is not there to look out for you. He's there to look out for his interest. My business is very different. I'm a hired gun that has to put myself on the side of the client, and I have to tell the client how everything works so that they can have information that doesn't have any part of the sales process built into it. That's why I'm not allowed to earn a commission or compensation of any type whatsoever. I can charge my client a fee. I can charge them by the hour to give them advice, but I have to be responsible for the accuracy of what I tell them. So it's just a different type of business. So I wanted to expose that because many people blindly do business with their broker down the street buddy, and they have no idea the type of environment that he lives in. And so I'm not faulting that broker for being in that environment. I lived in that environment for a long time. I'm just faulting the system because it's really, I think we owe our clients and the people that hire us and pay us a duty of genuineness. That's what they acquire when they hire me. And the brokerage business is oftentimes trying to look out for itself. And that'll manifest in about a dozen different ways for the typical client. And I expose those ways and give examples of how this plays out so people can see from their experience these things that they've stumbled across in the past. And all of a sudden it makes a whole lot more sense when they understand how the system is built. So the first third of the book is about how that ecosystem is built and how it manifests issues for investors. But the back 2/3 of the book is the mental games that we play with ourselves to seek entertainment, to seek affirmation, to make up for the fact that when we were little, nobody chose us for the soccer team. There's mental baggage that we have from all these little micro experiences that defines who we are. And we compensate for that with the way we pursue affirmation from other people. And money is a tool by which people get that affirmation. And it causes us to play the game in a way that is not statistically optimal. I deciphered for you a minute ago about the taxes, and you would not choose a transactional methodology because there's so many disadvantages to it. You would choose a different method if you could get past the ego and the taxes, but we always come back to wanting to do it a particular way because it makes us feel good. And we are emotional creatures and we make decisions based on how we feel about things, not what we think about things. And so that's okay. You just have to understand that that's not going to lead to optimal outcomes. And if you think the system is somehow rigged to get you, it's rigged to get you because you are rigged to get you. And so the system also knows that people act this way and think this way. And the brokerage system is built to take advantage of those inherent biases that we have by being human. So the back 2/3 of the book explores how that manifests and the way a proper decision-making methodology would be used to override our tendency to do things that are harmful to ourselves.
Yeah, I love that. It's just delves so much deeper into the mindset stuff like we talked a bit about earlier today, and really, empowering us of how we should be thinking, and the emotional side of it, which is really powerful because, yes, people do make buying decisions, investment decisions more based out of emotion and sales like that. So, yeah, really powerful. It sounds like a really, awesome book there. Definitely recommend people to check that out. And let's talk just quickly about coaching, mentoring again, because we talked about it a bit before, but I just want to highlight this about like how important coaching and mentoring has been for you in business and life, and what you've done and how it's helped you, to achieve what you've achieved.
Well, I haven't had a good mentor in a long time. 39 years ago, when I got hired in the business, I did get taken under his wing by a fellow in the brokerage business by the name of Jim Fearno. Unfortunately, he died 2 years ago. He was quite a few years older than me, and he sort of explained a lot of the brokerage business to me. But what I learned about the business was really through cause and effect, school of hard knocks. I bumped up against a few things that, I had to learn along the way. And people tend to live their lives to avoid that school of hard knocks, but really I've learned some of my best lessons from things that I have really been harmed by. And I don't think we're doing ourselves a favor to seek to avoid all that. I don't think we're doing our children any favors by seeking to make their lives easier. The hard life that I had was due to my parents getting divorced when I was 10. My mom filed for bankruptcy. Her car got repossessed. We just had some financial trauma. And when I went to work for E.F. Hutton in the 1980s, I was tapped to be a manager. And all along that training process of being in management in the brokerage industry, I was asked to do a study of the top 100 advisors at the firm. And I was given their phone numbers, and I was given a list of questions to call them and ask them. And I was to log that into a giant spreadsheet, looking for the commonalities of what makes these special people special. And the most common factor among those 100 advisors was financial trauma as a teenager. And that financial trauma as a teenager instilled in these people a resilience, a grit, a desire to achieve, a desire to overcome their circumstances. And in the absence of that trauma, I'm not so sure that I would be where I am today. If I had had an easier upbringing, and my mother, who will be 92 next month, says to me periodically, I wish I could have made your life and your brother's life easier. And I tell her, I don't. I do not wish that I had an easier life, because I promise you, I would not have achieved what I have achieved if I had had an easier upbringing. And so I think that's something that people need to look at with regard to how they engage with their children, and the lessons that they teach them, and the lessons that they should allow their children to learn on their own. So that's kind of my thought on the topic.
Yeah, I love that. I clearly agree with all of that. So powerful. And I had it tough for my parents being high school teachers, and I dropped out of school and got a job. They didn't like that. And my dad told me I'd never be able to study. My teachers told me I wouldn't be successful, right? So, but because I had a sporting background, I thought, watch me, right? Like, I'll show you that I can do this, and that, right, you build it, right? And I went back to do an MBA, even though it was hard for me to study, but I was like, I'll prove to people that I can push through this and actually make it happen. And that's what I'm seeing a lot when I speak to a lot of people these days, especially about the younger kids of today, where they're getting that instant gratification. They're getting things at their fingertips, and they're not going through some of these hard yards. It's a talent market, right, as well at the moment. So, you know, they're just getting jobs, or they can change jobs easily, and they're wanting like pay rises within a year and all of these things without going through the hard yards of us like working longer hours to try and look good to the managers so that we could, you know, go through some of those hard times. So yeah, I love that. Really powerful. So the it's been a very, very powerful episode today. I loved all of this, Gil. And just as we're sort of wrapping up here, what one key piece of advice would you like to give to all the entrepreneurs watching and listening today?
Well, you know, it's just kind of a reiteration of what we talked about in terms of paying attention to the taxes that you might otherwise pay. That can have such a profound effect. I would have people think long term think in terms of decades. Don't think in terms of, you know, getting to the end of the month and seeking gratification from the things that you invest in. And so real profitable investments take decades to come to fruition. And I think that I would think more strategically about my situation as opposed to making more rash moves. And when in doubt, don't do anything. So that would be the piece of advice that I would give.
Yeah, awesome. Love that. So true. Awesome. And yeah, we connected through our networks. So I learned about your awesome journey from, you know, being a senior portfolio manager, now being the president of Segment Wealth Management. Awesome guy, so knowledgeable, and I'm sure you'll continue to help people with investment strategies, tax efficiency, and asset management services. You know, very grateful that we connect, and I look forward to working with you. So Gil, how can people find you and get in contact with you?
Yeah, so I have a personal website. That's gilbaumgarten.com, BAUMGARTEN. I have artwork. I do sculpture. I do paint. There's a lot of things about my personal life that's on that website. And the name of my firm is Segment Wealth Management. So that's segmentwm.com. My book is Foolish. It's on Amazon, Target, it's on Audible. People can download the book there if they want to learn more, or reach out if they have any questions. You can email me at my segmentwm.com email address. And so, yeah, those would be the easiest ways to get in touch or find out more about the things I'm involved in.
Yeah, awesome. Love that. Definitely check out Gil websites and book and everything else like that, guys. So knowledgeable as you've shown today. It's just a taste of it. And if you wanted to, yeah, really up your wealth game in there. And thank you to everyone for watching and listening to this show where we talk about everything on business growth. And please like, subscribe, and leave us a 5-star review. You can find me on LinkedIn, Facebook, Instagram, and YouTube as Athin Cassiotis, or visit my website, athincassiotis.com. If you want to grow and scale your business, you can reach out to me on any platform to see if we're a good fit. I completely agree with you, or do I? The only way we know is if you tune in next time. So until next time, remember that our business grows when we learn skills and take action using them in spite of fear. So remember to design your growth and results.